All right. Welcome back, 10Xers. Now, let's briefly recap. So, mindset, right? We talked about mindset. We're all stuck in that 20, 30% return mindset. Simply, we're not looking for that tenfold return. That's the main thing. Mindset is number one. Secondly, we talked about inflation. I keep reiterating governments print money, and that's a big part of the 10X strategy. Lastly, and this ties in with governments print money, is that the system is rigged. We know what the government is going to do. We know they're going to print money. When they print money, this is inflation. This causes asset prices to go up. So again, the system is rigged. It's rigged in your favor. All right? Now, this week, we're going to look at the last components we'll need to build our 10X portfolio. Remember, this is 30 years of experience coming together. So let's get into it. The 10X strategy has three primary components. This is a base. Going forward, there'll be other components added, but this is what we need to get started. Component one is we're going to model top investors. Literally, we're going to copy the best of the best investors. Secondly, we're going to think in 10-year blocks. And third, we're going to focus on the right industries. Got it? So simple. Previously, we talked about the financial industry. They want you to buy and sell stocks. They want you to trade. They want to mentally trigger you. They want to trigger your emotions. When we get excited, we're not maximizing our gains. Big money. The big money makers like Warren Buffett, Bill Ackman, Carl Icahn, Jeff Bezos, and the like, they own just a few great companies. That's it. And the few companies that they do own, they own them as if it's their own personal business. And that's what we need to do. We need to start thinking like business owners, not like stockholders. See, business owners are different. They're more focused, they're more deliberate, they're patient, and basically they're just different. They're, than being a stock trader, right? Warren Buffett says this: the stock market is a device for transferring money from the impatient to the patient. Again, the stock market is a device for transferring money from the impatient to the patient. Take that to heart, all right? Of course, patience is subjective. For our purpose, patience is a mindset. We're going to use 10 years as our marker, okay? This means we're going to look 10 years into the future when we research our companies. We're also going to think in terms of holding the company for 10 years. Why do we use 10 years? Because great companies plan in 10-year, they plan 10 years out. Great business leaders like Steve Jobs, they think in terms of 10-year blocks. Their next product, their next service, it's not created overnight. When you see a new product from Jeff Bezos or Elon Musk, these products were in development many years in advance. The 10-year mindset also allows you to ignore information and market gyrations that are distractions, very simply. So, What exactly are we looking for in a 10x company? We need companies that have been and can continually grow, right? We grow their revenues for the next 10 years or longer. Got it. We're looking for structural market advantages like technology, biotech, and consumer goods. Very simple. And just as important as what we buy, it's equally important to avoid industries such as airlines, home builders, and automakers. Sure, you can make money with those industries, but we're looking to grow our investments tenfold, right? We need supercharged companies to do that, not cyclical companies. Remember, also remember, some companies need to print stock to raise capital. We need to avoid those companies, right? Companies that print stock excessively. In essence, we want to avoid companies that are dead weight. To find our next great company, we don't need rocket science, right? The most important metrics can be found at Yahoo Finance. Go to Yahoo Finance, click on Statistics, and all the information that you're going to need is right there. Okay? We're keeping this basic. We're going to look at only 4 key metrics. Quarterly revenue growth is the first one. That's important, meaning quarter over quarter, the company is sequentially growing its revenues. This type of revenue growth covers the many ills all companies face. Number 2, we're going to look for earnings growth, right? Earnings growth is good, but it's okay if the company is losing money. But in exchange for losing money, the company needs to be growing revenues, meaning management can show a profit if they chose to slow revenue growth. So if they're buying revenue growth with earnings, that's fine. But that's an exchange. By the way, these type of great companies are few and far between. So once you grab one, you hold on dear life. The third component is total cash. Is the cash on hand sufficient to fund the growth of the company? That's very important. The fourth and final component is debt. Is the debt level manageable? Sometimes you'll see a great company or a great situation, but the debt is a struggle and a stranglehold on the company's growth. That's not good. And remember, debt is dilutive. Debt is the flip side of inflation. Now let's look at 4 companies. 2 of the companies are oldies. One is a newbie, and one is a potential 10x. First, we have Microsoft, right? Microsoft most recently 10x'd, going back to 2016. So the company is up tenfold in 8 years. They have incredible market dominance and very stable long-term growth. It's a superb business. In general, software is a great business to be in because it's low overhead and tremendous leverage. This is something we can look at when we're looking for our next 10x company. And notice, Microsoft is a company that has 10x'd multiple times. Now let's look at an oldie, McDonald's, right? Very old name. The last time they 10x'd, right, or the most recent 10x goes back to 2004, right, till now. It took 20 years, but again, it's McDonald's, right? It went up tenfold to 10 extra, right? Again, this company has tremendous market dominance and stable long-term growth. And just when you think they couldn't grow anymore, you think they've saturated the market, they continue to expand globally. I chose these companies carefully because they hold valuable clues we can use to pick the next 10x companies. The next company is NVIDIA. Just a great performer, right? The company 10x is going back to 2022. So basically in 24 months, the stock went up tenfold. Its revenues and earnings growth is tremendous, but it wasn't an easy pick because NVIDIA is a semiconductor company, and semiconductors are cyclical, is a cyclical business. By rule, you'd want to avoid such an industry, but this is big and it's significant. What we have going on is a sea change, and that sea change is artificial intelligence. I love the artificial intelligence theme because over the next 10 years, the industry will be taking shape. The next 20 to 30 years, the industry will continue to be wildly fruitful. So here's a cheat code. The leading company in a leading industry is a unicorn. NVIDIA is a unicorn. Now for the last company. This last company has not yet 10x'd. The company is DraftKings, the online sports gambling platform. Ticker symbol DKNG. It's around $38 per share, right at the time of this recording. It's a market leader, and its revenues are growing. DraftKings is a digital casino. This is an industry that's going to be around for a long time. Earnings are not quite positive yet, but the company is aggressively capturing market share. So this is the type of company that could turn off the marketing spigot and show a profit. Got it? Lastly, note DraftKings has no footprint overseas. They're not going overseas because of tremendous growth opportunities here in the United States. This is decades of untouched business. And debt for the company is manageable in relations to the cash on hand. So instead of waiting till next week to add DraftKings to the 10x model portfolio, we're doing it this week. DraftKings is officially the first company in our model portfolio. Congratulations to DraftKings. Now, I'm not saying to buy DraftKings. I'm saying do your homework based on the 10x model, right? Research it, then make your decision. From time to time, we'll check in on DraftKings. We'll start, and starting next week, we'll add a second player to our list, and we'll keep track of that company also, right? So let's end it here. Again, we've got the final metrics, right? Which is revenues, earnings, cash, and debt. Take a look at these, make sure you understand them. In the future, we'll add more metrics, but it'll get a little bit more complicated. And again, we've got DraftKings as the first company in the model, and next week we'll look at another one. And remember, right? Like and subscribe. Set your alerts so you don't miss the updates. We'll talk to you soon. Bye for now.